Hello everyone. In this class, I am going to continue the topic of basic accounting concepts. In part 1, we discussed four basic accounting concepts. They are business entity concept, money measurement concept, going concern concept, and accounting period concept. So now we will move to the fifth one, that is cost concept. It says the cost concept requires that all assets are recorded in the books of accounts at their purchase price. This purchase price, which includes cost of acquisition, transportation, installation, and making the asset ready to use. So, the purchase price, it is inclusive of all these, that is cost of acquisition, transportation, installation, and making the asset ready to use. Here I will explain this cost concept through one example. So here we will take we purchased an old plant for rupees 50 lakh. So the purchase price is rupees 50 lakh, which is into the business of like we'll take manufacturing detergent powder. Purchase price of old plant, that is rupees 50 lakh, and an amount of rupees 10,000 was spent on transporting the plant to the factory side. So transportation cost equals to rupees 10,000, and rupees 15,000 it was spent on repairs for bringing the plant into running position. So the repair cost is rupees 15,000, and rupees 25,000 on its installation. So installation cost rupees 25,000 on its installation. So so these total cost, that is 50,000. This is the total of 50,000. Here we have to, whether we have to record only this purchase price or inclusive of all these cost. So the answer is we have to be recorded in the books of account rupees 50 lakh 50,000. How? That is 50 lakh purchase price plus 10,000 transportation cost and plus repair cost 15,000 and plus installation cost 25,000. Total of all this, that is 50 lakh 50,000, we have to be recorded in the books of accounts. I hope this concept is clear to you all. Now we will move to the next one, that is dual aspect concept. Means this concept states that every transaction has a dual effect and therefore be recorded in two places. Fine. This concept states that every transaction, it has a dual effect and therefore be recorded in two places. So here also I will explain this concept through one example. Suppose a firm, it purchased goods worth rupees 10 lakh. So in this transaction there is mainly two aspects will come. That is, we are purchasing the goods and we are paying the cash. First one, that is we are purchasing the goods, and second one is we are paying the cash for what? For purchase the goods. Fine. So this is the dual aspect concept. So thus the duality principle, it commonly expressed in terms of accounting equation. So this dual aspect concept, it is commonly expressed in terms of accounting equation, that is assets equals to liabilities plus capital. This equation I will explain through one example. So we assume the owner of the business, he invests rupees 50,000 as capital. So capital, that is equals to rupees 50,000, and owner, he takes, or the business, it takes a loan of rupees 20,000 from a bank. Loan, that is equals to rupees 20,000. Capital 50,000, loan 20,000. After that, what he will do? He purchases an equipment or machinery worth rupees 40,000. Equipment worth rupees 40,000. And again he will purchase one furniture of rupees 10,000. And that owner has cash of rupees 20,000. Fine. In this problem, see, equipment, furniture and cash, all three comes under the head asset, and these all are liabilities. Fine. What is the equation? Assets equals to liabilities plus capital. Assets equals to liabilities plus capital. Here assets, total of assets 40, 50, 70,000. And liabilities, here see, loan, it will come under the head liability, that is 20,000, and capital 50,000. So here assets equals to liabilities and capital. I hope this equation is clear to all of you. Fine. Now we will move to the next concept, that is matching concept. It states that expenses incurred in an accounting period should be matched with revenues earned during that period. Expenses incurred in an accounting period should be matched with the revenues, means income earned during that period. Fine. Here also I will explain this concept through one example. See, here a company, it sells goods worth rupees 10,000. Sells goods worth rupees 10,000 in January. And the cost of purchasing these goods was rupees 6,000. Cost of purchasing these goods rupees 6,000. Fine. Here now we need to identify the revenue. The company records rupees 10,000 as revenue in January. So here revenue rupees 10,000 in January. Why? Because the goods were sold in that month. Fine. And what about expenses? Expenses, the cost of the goods sold is also recorded in Jan only. Why? Because it directly relates to the revenue generated in the same period, that is rupees 6,000 in the same period in January only. They sells the goods of rupees 10,000 in Jan, and the cost of purchasing these goods that is rupees 6,000, that is also in January. Fine. Now this ensures that the revenue of rupees 10,000, it is matched with the expenses of rupees 6,000. Fine. The revenue of rupees 10,000, it is matched with the expenses of rupees 6,000, showing a profit of rupees how much? 4,000 for January. Fine. For January. This is the matching concept. I hope all of you understand these concepts very well. If not, please leave a comment. Thank you.